Well, two things. Number one, I'm not going to know what day it is. I can tell you it's coming. I can explain how and why. I can estimate the order of magnitude of the crisis, but I won't know the exact day, or even if I did, I'd probably be a little busy that day.
As we navigate through tough economic challenges, it's crucial to acknowledge the ongoing recession. Business failures, rising unemployment, and a decline in GDP are unmistakable signs that the economic cycle is taking a downturn. Recession, a cyclic phenomenon, has historically occurred every 7 years, with notable instances in 2000, 2007, and 2020. However, what sets the current situation apart is its unpredictability. Renowned financial expert Jim Rickards warns that a severe recession is looming, and its impact could surpass analysts' expectations. The possibility of a 30% to 50% decline in the S&P 500 by 2023 is not to be taken lightly. Jim Rickards estimates combined losses exceeding $200 billion for creditors and stockholders. The Federal Deposit Insurance Corporation, or FDIC, is taking unprecedented actions, guaranteeing over $200 billion in deposits to restore confidence. But as Rickards warns, this may strain the FDIC insurance fund, ultimately impacting consumers. In this video, we will explore the signs that indicate the crisis is far from over. Recent bank failures, strange FDIC actions, and the Federal Reserve's unconventional moves raise questions about the real state of the financial system. Is the panic just beginning? And how can you protect yourself? Well, we will explore the crucial steps you can take to secure your assets in the face of this impending crisis. Let's talk about the state of the economy and something we've all felt: recessions. You might have noticed the turbulence in banks, loans, and mortgages recently, indicating a change in America's financial landscape. It's important to understand how recessions impact the economy. According to Jim Rickards, recessions are like those unwelcomed guests that crash the economic party. They bring about more business failures, skyrocketing unemployment rates, and a noticeable dip in gross domestic product, or GDP. The current recession we're experiencing isn't exactly a new song on the playlist. We've had similar downturns in 2000, 2007, and even as recent as 2020. The cyclical nature of these recessions is quite intriguing. We often hope for smoother financial sailing, but the reality is that recessions are crucial parts of the economic cycle. Looking back at these past recessions, it's fascinating to see their patterns. They seem to swing by roughly every 7 years, yet the timing isn't always spot on. As Jim Rickards points out, the financial world is about as predictable as a box of chocolates. Sometimes we've experienced back-to-back recessions, like the ones in 1980 and 1981, and here we are again grappling with another economic downturn. It's crucial to recognize that these recessions aren't set in stone. They vary in duration and depth. Jim Rickards suggests that the current recession might hit harder than initially estimated. Analysts predict it could nosedive by up to 30%, and if things really go south, we might be staring at a potential 50% plunge in the S&P 500. Shocking, right? The warning signs of a financial crisis. Have you ever wondered how you can spot the warning signs of a financial crisis before it hits? Well, according to financial expert Jim Rickards, there are some glaring signals that we would be paying attention to right now. In recent statements, Rickards has issued a stern warning about the possibility of a recession that could be even worse than analysts predict, potentially leading to a significant downturn of 30% to 50%. Now let's take a little trip down memory lane to the 2008 financial crisis, an event etched in the minds of many. It was like a domino effect, starting with mortgage losses soaring beyond expectations. The whole world washed as financial institutions like Bear Stearns and Lehman Brothers toppled, sending shockwaves through global markets. Credit markets froze, industrial production nosedived, and the impact reverberated worldwide, causing a staggering loss of over $2 trillion in global economic growth. It wasn't just a US problem, it affected economies across the globe. That crisis was a stark reminder that when the financial world sneezes, the rest of the world catches a cold. Let's zoom in on one infamous crisis within a recession: the subprime mortgage crisis. Remember that one? It was a classic case of a crisis occurring during a recession. The expansion of easy mortgage credit led to a housing bubble that burst spectacularly. Home prices plummeted, causing a wave of foreclosures, leaving people without homes, savings, and jobs. The crisis wasn't contained within the US. Its shock waves were felt globally, illustrating how a crisis in one sector can trigger a ripple effect across the entire economy. But wait, let's rewind the clock even further back to the 1930s. Specifically between 1931 and 1933 during the Great Depression. Jim Rickards often draws parallels between this historic period and what we might be facing in 2023. Back then, it was a dire situation with multiple bank failures, consecutive devaluations of currencies, and a complete halt in world trade. The echoes of that time are hauntingly familiar to the warnings Rickards has been sounding. Fast forward to today, and Jim Rickards is raising eyebrows by suggesting that the history books might be dusting off a familiar script. Are we about to see a rerun of the great economic drama of the past? Jim believes the signs are there. Now let's talk about something that's been making headlines, and not the good kind. The recent collapse of not one, not two, but 5 major banks in just 1 month. I mean, that's like a financial domino effect, and it's got Jim Rickards raising some serious eyebrows. We're not talking small local banks. We're talking about Silvergate, Silicon Valley Bank, Signature Bank, First Republic Bank, and even Credit Suisse, one of the big guns. Jim is not sugarcoating here. The combined losses here are a whopping $200 billion. Yeah, you heard that right. So the big question is, what's going on? And what does it mean for the rest of us? Now let's talk about something unusual that the FDIC, the Federal Deposit Insurance Corporation, did in response to this chaos. You know, normally the FDIC insures deposits up to 250 grand per account. But guess what? After the recent bank debacles, the FDIC took a wild turn. They're guaranteeing deposits that exceed a whopping $200 billion, something they've never done before. Jim Rickards has raised some serious red flags about this move. The concern doesn't just end there. There's this underlying worry about the long-term repercussions. If the FDIC is tossing around guarantees like confetti, who's footing the bill in the end? Jim Rickards predicts that this move might put a colossal strain on the FDIC insurance fund. And guess what that means? Ultimately, it could trickle down to us, the everyday consumers at the bottom of the financial ladder. So, let's talk about the Federal Reserve and their recent moves. Have you heard about the BTFP or Bank Term Funding Program? It's essentially the Fed's way of saying, hey, let's pump more money into the system. Now, Jim Rickards, our financial guru, has been watching this closely, and his thoughts on these actions might make you raise an eyebrow or two. The thing is, these extra loans through the BTFP seem to be stirring things up in the US banking system, and not necessarily in a good way. Jim Rickards is not entirely sold on the intentions behind these measures. He's got this knack for asking the tough questions. Are these steps taken by the Fed to genuinely calm the public's nerves, or is there more to it, like a safety net for a chosen few big shots in the banking sphere? What's becoming clear from all this is that these actions aren't just casual maneuvers in a broad room. They're creating ripples of uncertainty. The big question lingering in the air is whether these moves will truly stabilize the banking system over the long haul. It's like the Fed's playing catch-up, but are these tactics just adding fuel to an already fiery financial scenario? Let's take a deep dive into a pretty intriguing aspect of this brewing financial storm: technology's role in potentially amplifying the crisis. Picture this: in the age of lightning-fast digital transactions, if a bank faces trouble, people can swiftly move their funds with just a few clicks on their devices. Yep, it's that easy. And Jim Rickards has been peering into his crystal ball, predicting that this ease of fund transfers in the digital era could accelerate the panic during a crisis. I mean, think about it. When news hits that a bank's in trouble, you don't need to queue up at the branch to move your money. You just whip out your phone and zap, it's done. Jim Rickards is hinting that this lightning-quick ability to shift funds could fan the flames of panic even faster than before. It's time to talk about the big picture, the global repercussions if our trusty reserve currency, the dollar, were to stumble. Picture this: Major players on the world stage like China, Russia, Saudi Arabia, Brazil, and Iran are gradually steering clear of relying too heavily on the dollar in their international dealings. Now, what's our financial guru Jim Rickards got to say about this? Well, he's painting a vivid picture of the potential fallout if trust in the dollar continues to wane. See, as confidence in the American government dwindles, it could set off a chain reaction, a domino effect that might shake up not just banks, but also the very foundation of the dollar itself. Now, when it comes to safeguarding your wealth amidst this brewing financial storm, Jim Rickards has a strong suggestion: gold. Yep, you heard that right, good old shiny gold. Jim's been a strong advocate for gold as a safe haven asset during turbulent times, and he's not alone in this belief. Recently, members of the US Congress introduced the Gold Standard Restoration Act, which is a pretty significant move. It's like a flashing neon sign, signaling the importance of considering gold as a hedge against economic uncertainties. Jim has been vocal about this, emphasizing that having gold in your portfolio can act as a shield against the potential fallout of a looming financial crisis. So if you're looking for a way to protect your wealth when the storm hits, gold might just be the key that Jim Rickards is urging everyone to grab hold of. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.